Now that we understand when an actual valuation is required, let's explore what factors actually derive the calculation of this leave liability. So, the actual liability for leave benefit is not just a simple sum, it's a complex calculation which is influenced by the four primary pillars as shown in this quadrant. First, employee data. This is the foundational information about your workforce. Second, policy details. This is specific of this is particularly the company's leave policy. Third, assumptions, a series of forward looking estimates about future events. Fourth, methodology, specific mathematical and actuarial approach which is used to perform the valuations. So let's break down each of these drivers starting with the employee data. Accurate and comprehensive employee data is the bedrock of any reliable actuarial valuation. Here are the key data fields we look for. Employee ID name. It is essential for unique identification and tracking. Date of birth. It is crucial for projecting the retirement, attrition, mortality rates. Date of joining. It is used to calculate employees' past service and it directly impacts the accrued leaves. Applicable monthly salary for leave encashment. This is the specific salary component that forms the basis for valuing any leave that will be paid out as cash. It could be basic salary, for instance. Current CTC, the cost to company salary, it is used as the basis for valuing leave that is availed or used during employment, as this impacts the cost to the company at the time of usage. Category of employees. Different employee categories often have varying leave policy. For example, staff may have a different policy rules, workers may have a different policy rules. So category helps in applying the current rules. Closing leave balance. The accumulated leave balance for each employee as on a valuation date, it is a direct input to the liability calculation. And the last one is the leave balance movement. It helps in understanding how the leave balances have changed throughout the year. So, leave balance movement includes opening leave balance, accruals during the year, leaves taken during the year, encashments, lapsations, and the closing leave balance. It also helps in valuing the service cost for the year, which is a cost of benefits earned by the employees during the period. Now, beyond employee data, the specifics of your company's leave policies are equally vital. These details dictate how the benefits are earned, accumulated, and eventually paid out or utilized. So first is the leave types. Understanding all different type of leaves your company offers, example earned leave, sick leave, casual leaves, it helps determine which one require the valuation. Second is the accumulation rules. Now, this specify the maximum number of unused leaves an employee can carry forward. This cap is critical as it limits the total potential liability. Next is the encashment rules. It outlines precisely when and how leaves can be encashed, whether it's during employment or upon exit, and critically, which salary components are considered for this purpose. Is it a basic salary or a different component? Accrual rates and leave policy year. So, accrual rates represents how many days of leaves are earned per year. And leave policy year, basically it tells whether the leave year aligns with the calendar year or the financial year. Lapse rules clarifies if and when unused leave is forfeited, for example, at end of the policy year, and this can significantly reduce the potential liability if the leave expires at end of the reporting period. Last one is the benefit formula. So the calculation are done using this formula to determine the monetary value of the leaves. So the formula is expressed as applicable salary multiplied by the accumulated leave balances divided by the monthly divisor. Monthly divisor represents the number of days in a month. These policy details are directly fed into the actuarial model, ensuring the calculations reflects your company's actual obligations. Now, while carrying out the leave valuation, one of the main steps is projecting how an employee is likely to consume the leaves in the future years that are lying to his or her credit as on the valuation date. So, the first step is to understand the leave consumption pattern as per the leave policy of the company. Leaves can essentially be consumed in three ways: availed during employment. This is when employed take time off during their service. When the leaves are availed, their value is typically based on the employee's gross salary or cost to company, as the company bears the full cost of their absence. Second, encashed during employment. So some policies allow employees to encash a portion of their accumulated leave while still employed. The value here is usually based on a specific policy rate, often basic salary. And the third is encashment during at time of separation or encashment upon termination. Now, this is the most common scenario for vested on leaves. Upon an employee's retirement or resignation, their unused accumulated leave balance is paid out. This is also valued as per the policy and usually based on a basic salary. So, understanding these consumption pattern is vital for accurate projections. Predicting how leaves will be consumed in future years requires careful assumptions. Now, in many organizations with flexible leave policy, the leave valuations are carried out assuming that the future availment will be on last in, first out basis, LIFO basis. And this is a very common assumption. It assumes that any leave availed in future are first consumed from out of future accruals. Only if an employee takes more leave, then they will be consumed out of the closing leave balance being currently valued. That is the balances from the previous years. The rate of leave availment during employment is typically estimated based on the historical patterns of how the access leaves availed beyond what was newly accrued as a percentage of the opening leave balance. And we often look at last 2 to 3 years of data. Similarly, the rate of leave encashment during employment is estimated using the actual historical encashment data. It represents the percentage of accumulated leaves employees are expected to encash during their service to the opening leave balance. Now, these rates are crucial inputs to project the future utilization and encashment of leave balances. Now, let's elaborate on the LIFO versus FIFO assumptions, as these assumptions can significantly impact the valuations. LIFO, last in first out basis, as I mentioned in last slide, that in most organizations with flexible leave policy, future availments are often modeled on a LIFO basis. Typical utilization rates range from 2 to 5% per annum, depending on the workforce demographics and company culture. Crucially, LIFO typically leads to a lower liability. And why? Because the major portion of the closing leave balance, the older accumulated leaves, they are valued for encashment at time of separation, usually at basic salary, which is lower than CTC used for the current availments. FIFO basis, first in, first out. So here, organizations with structured leave usage policies, they might model the consumption on a FIFO basis. It implies that the oldest leave entitlements will be used first. This often results in a higher utilization rate as employees prioritize using older leaves before it potentially lapses or to clear the old balances. FIFO typically leads to a higher liability because the future availment is valid on CTC, which is higher than the basic salary, and the older leaves, which might have been cheaper to pay out at basic, is now being consumed at a higher cost. Now, beyond leave utilization, there are several other critical assumptions which are made to project the future cash flows for leave benefits. These are actuarial assumptions based on financial and demographic factors. So, the first one is salary escalation rate. This is the expected annual increase in employee salaries. Future leave payouts will be at future salaries. So, this projection is important. Discount rate, it is used to derive the present value of future liabilities. It reflects the time value of money and is typically based on the government bond yields for the estimated term of obligation. Next is the attrition rate assumption. It represents the expected percentage of employees leaving the organization each year due to resignation or termination. And this impacts how many employees will actually remain to claim their leave benefits. Next one is the mortality rate, probability of employees dying in service. It is based on the standard actuarial mortality tables. Next is the leave utilization encashment rate. As we just discussed, the expected percentage of accumulated leaves that will be used or encashed during employment. Last one is the retirement age, the assumed age at which employees will retire. And this is a key trigger for the payout of accumulated leave benefits. Now, these assumptions are not mere guesses, they are carefully chosen based on the historical data, market trend, and the expert judgments. Now, let's talk about the core of the valuation process, the methodology. The project unit credit method is the prescribed approach under the accounting standards like Ind AS 19 and AS 15 for valuing other long term employee benefits, including accumulated leave benefits. PUCM method involves three main steps. First, project future leave benefits. Under this, we estimate the benefit payable at time of retirement, termination, resignation, or during employment. Factors considered here includes projected salary increase and the patterns of leave utilization and encashment. In second step, we apply the demographic factors. We estimate the expected future payouts by applying demographic factors such as attrition rate, mortality rate, disability rate, retirement rates. This helps us predict who will receive the benefits and when. The last step is discount future benefits to present value. This is a crucial step. We discount the future expected payouts back to the current reporting date using the government bond yields. This gives us the present value of obligation. Finally, we aggregate these present values derived for each employee to arrive at the total actuarial liability. Now, this method systematically builds up the liability by considering the future events and then bringing them back to today's value.